Well, good morning, Jaginder Rana here. The topic of the day is growth of general insurance in India. Growth of general insurance in India. The overall growth in premium underwritten by general insurance companies declined during the quarter ended June of FY25 in the wake of the lower growth rate in the motor and health segment. So the growth in premium underwritten declined to 13.33% at rupees 72,758 crore in the June quarter of financial year 25 as against a growth of 17.88% in June quarter of 23 and 22.15% growth in the same period of 22. So the growth in premium underwritten in the health insurance segment fell to 16.58% at rupees 29,915 crore during the June 2024 as against the growth of 20.75 in FY23. New India Assurance, the largest insurer, reported a 2.82% growth in premium underwritten at rupees 10,670 crore during the June quarter of FY25 as against a growth of 8.66% in the same period of FY24. So India being one of the fastest growing insurance market still has a relatively low insurance penetration rate of 4% of its GDP, leaving a sizable gap. This gap is largely due to a lack of awareness and accessibility of insurance and its critical role in financial stability during unforeseen incidents. In the wake of the lower growth rate in motor and health segment, growth in premium underwritten declined to 13.33% at rupees 72,758 crore in the June quarter of FY24. However, the general insurance sector received a major relief amounting to over rupees 18,000 crore with the GST Council dropping demand for GST on insurers. So the industry's demand will be sustained by robust growth in health segment as well as in motor segment. Additionally, competition is slated to rise, especially in the health segment, as new companies have commenced operations while others continue to be in line to enter the segment. The Indian non-life insurance market will grow at a rate of approximately 13 to 5% in the medium term. So the overall business growth would be supported by macroeconomic factors, a favorable regulatory environment and the Bima Trinity. Further, a focus on containing overall expenses and strengthening distribution network is also anticipated to contribute to the sector's growth. So additionally, reports of composite license and M&A, means merger and acquisition, could alter sectoral dynamics. The overall outlook for the non-life insurance sector remains stable in the medium term. Our intensified competition and an uncertain international geopolitical environment could potentially affect economic growth and subsequently impact the non-life insurance sector. In June 2024, ahead of the union budget, the general insurance sector received a major relief amounting to over 18,000 crore with the GST Council dropping its demand for GST on the insurers, though it is yet to be approved. So the relief allowed by the GST Council include the dropping of GST demands amounting to over 18,000 crore at an industry level, providing a significant respite to the sector. Because the GST demand was on co-insurance and reinsurance commissions and taxing of reinsurance on crop schemes. So the GIC Council argument was that GST demand on co-insurance and reinsurance commissions lack a legal foundation, and it also highlighted the implication of taxing reinsurance of crop insurance scheme, as it may not benefit the farmers. So these efforts culminated in the GST Council granting the much needed relief. So India's general insurance sector is expected to grow by 11.2%. This growth is expected to be driven by the following factors like personal accident and health, motor and property. These insurance lines accounted for 93% of all general insurance premium in 2023. So the economic growth and rising disposable income have contributed to the growth of the general insurance industry in India. Now, consumers' awareness is rising, and this rising awareness of health and other general insurance products has supported the growth of the industry. So robust regulatory reforms have also contributed to the growth of the industry. In the health segment, the growth was the strongest, accounting for about 50% of the incremental GDPI. The growth in the motor OD was supported by the strong growth in the vehicle sales. The net loss ratio of the fire segment was impacted by the high frequency and severity of Nat Cat events in FY 2024. Profitability for private players remained strong due to improved investment income. So these are a few aspects which are showing that the growth of general insurance business in India is bound to take place, because the general insurance sector of India is projected to expand by 11.2% because of these lines like personal accident, health, motor. They are all contributing to it. The growth in vehicle sales was also fueled by the government's vehicle scrapping policy, which came into effect from April 1st, 2023. So the policy requires private vehicles older than 20 years and commercial vehicles older than 15 years to be scrapped. Motor insurance is expected to grow at a CAGR of 7.9% during 24 to 28. Property insurance, the third largest segment, is projected to hold a 22.5% share of GWP in 2024. So growing by 10.4% due to increased infrastructure investment, which has been allocated $134 billion in the 24 to 25 budget. So this segment is expected to grow at a CAGR of 8.3% over the same period. Now, liability, marine, aviation and transit insurance along with other general insurance products are estimated to account for the remaining 6.8% of GWP in 2024. The combination of economic recovery, rising disposable income, and favorable regulatory reforms will drive the growth of India's general insurance sector. So, despite a current insurance penetration rate of 0.98%, which is lower compared to other Asian markets such as Japan, South Korea, Hong Kong, and China, These factors are expected to enhance penetration and growth in coming years. This this is expected that the growth of industry GDPI was strong as 15.5% year on year in financial year 2024 to rupees 2.79 trillion. So the health segment witnessed the strongest growth, accounting for 50% of incremental GDPI of rupees 375 billion in 24. With the rising awareness of health insurance and increased ticket size, further the strong growth in vehicle sales supported the growth in motor OD. So with the high frequency and severity of the net cat events in FY 2024, the net loss ratio of the fire segment was impacted. However, considering the reassurance and low retention in this segment, the impact on the overall net loss ratio of the industry was manageable. So profitability for private players remained strong, supported by improved investment income, which is likely to continue. Adjusted ROE for private players expected to improve to 12 to 14% in FY 2025, with improvement in underwriting performance, combined ratio of 105 to 106%, over 106 to 107%. So the PSU insurers posted a small net profit of 9 million in FY 2024 over the net losses in the previous years, but driven by an improvement in the combined ratio and higher investment income. Improvement in combined ratio was supported by the absence of the retrospective wage revision and payment of associated areas in FY 2024. Solvency for the three PSU insurers, excluding New India, continue to remain weak at negative 0.5% time, excluding fair value changes on investment as of December 2023. So capital requirement for the three PSU, excluding New India, estimated to be sizable at rupees 94 to 102 billion to meet the solvency of 1.50 as of March 2025, assuming 100% forbearance of FVCA. So industry GDPI grew by 15.5% to rupees 2.8 trillion in FY 2024. Now the question is, this data shows that including 100% of VCA, the solvency of PSU insurers, excluding New India, estimated at 1.04 by March 2024. So the growth is unabated. Growth will continue because premium is growing day and night, every day, of all the general insurance companies. Only thing is, the growth has to be profitable. So efforts have to be made because in July 2024, the general insurance sector showed a positive trend with a 9% increase in premiums compared to the same month last year. So for the first 4 months of FY 24, premiums surged by 12%. The standalone health insurance sector showed decent performance with premiums rising by 23% in July 2024. Over the first 4 months of FY 25, the growth was even more pronounced at 24%. Market share also saw a significant increase, rising by 112 basis points to 11.39% from 10.27% in the same period last year. So this is a good sign. Industry is growing. and the report is also positive. Companies are performing well. Simultaneously, new companies are also entering into the market. This will increase the growth, and the growth is expected in double digits. So the general insurance industry has ended the fiscal FY24 with 13% growth, but FY24 growth is lower than when compared with 16% achieved in previous year. So the non-life industry continues to be driven primarily by the health and motor insurance segment, though it was marginally subdued in FY24 due to a fall in liability, crop insurance and marine cargo, while fire and credit guarantee segment reported subdued growth numbers compared to last year. So Indian non-life insurance market will grow at 13 to 15% in the medium term. The industry's growth will be primarily driven by the health and motor insurance segments, supported by increasing disposable income levels and a rise across the other segments. Thank you very much.